Okay, welcome to the Money Market Show. I'm your host, Paul LeJoy. So every once in a while, preferably every week, we have a key lender, a lending partner that we feature on our show. So to help you, real estate agent, as well as you, the consumer, you, the maybe the investor, right? Broaden your horizon. Maybe as a real estate agent, we bring you this deal so that, or bring this platform so that you can service more clients, whether they're consumers or they are investors. And if you're an investor watching this, okay, and you're a direct consumer, by all means, you're going to learn a lot today because I have known Cari Anderson from AXOS Bank for some time now, and some of the programs she has, especially now in the climate of increasing mortgage rates, you will learn a lot. So, Cari, welcome to the show.
Thank you. Thank you for having me.
So we're gonna keep this sweet, right? And I'm just excited to talk about a few things. You have the jumbo portfolio arms. You got the pay option. You get buy before you sell, flexible income niches, investor-friendly niches, cash flow niches, credit niches. Good. That's a whole bunch of things to cover today. Let's start with the jumbo products.
Yeah, so we are a bank. We are an FDIC insured publicly traded bank. And all of our products are what we call portfolio products. And that means that we keep them on our books and on our balance sheet. We service the loans. We do not sell them on the secondary market. So that just translates into greater underwriting flexibility because we're keeping those loans and servicing them. So all of our loans go up to 30 million. And we do have a minimum loan amount of 500,000, which isn't very difficult to achieve in our area. But yeah, so that's the gist of it. They are all fixed period arms, 30-year terms, and our pricing is actually very competitive in the market right now.
Yeah, I saw some of you every morning. I get the rate sheet from you guys, and I think it's the most, I would say one of the most competitive. So I'm glad that we're partners. The money market is partners with you guys, so that instead of somebody going to Wells Fargo, Chase, or Bank of America, or Citi, they can come to us, and we can give them the stuff. So for you, if they go to Bank of America or they go to Chase, they're looking at full doc, right?
Right.
So what is your specialty? Is it full doc or what was it?
Yes. So we have a couple different ways of qualifying borrowers. We have our full doc, which is, again, because we're a portfolio lender and because we don't have to make all our loans look exactly the same to an investor, we can deviate from our guidelines and do what we call manual underwriting, meaning, again, we're not trying to make everything exactly the same, so we can deviate from our guidelines. And we also offer bank statement income underwriting, which just requires business bank statements versus having tax returns to review. And that's more of what we call cash flow analysis for self-employed borrowers. Instead of looking at their tax returns, we're looking at their business cash flow. And then finally, we have what we call a debt coverage loan, and that is for investment properties where the only qualifying is the property's net operating income in relation to the debt. So there's a lot of creative ways that we can finance a property. We also allow the use of their assets, their liquid assets, like their stocks and their savings. We can use the balances on those accounts and do an income calculation from those assets where they really don't have to set up any draws on their assets. We're just doing a calculation to give them extra qualifying income.
So that's good. So if somebody to buy a property, let's say in Pebble Beach, I've seen some properties on the MLS that are over there in Pebble Beach and Woodside and all that kind of stuff, those extravagant properties, right? But they're a business owner and they cannot show basically tax returns. So this is going to be good for them, right? This
Yep.
They can't go to Wells Fargo and get that, right? Because you're using bank statements.
Right.
So tell me, where do you stand? So the other day we were talking about, some of the loans, if you go to maybe Chase or Bank of America, you must be a private client. But but when they come to AXOS Bank, you don't need to be, you need to meet the same criteria. So
No, we don't require a banking relationship right now. However, we do have an incentive for banking relationships, getting you a better interest rate that way, but it's not required. So we welcome borrowers who don't wish to establish a banking relationship. And for those who do, we're going to give them an incentive on their rate. So it's the best of both worlds.
yeah, I've seen that, right? You're giving like a quarter point off if they use
Right,
you.
right.
That's great. That's awesome. That's awesome. Okay, so going back again to Pebble Beach and the expensive parts of California,
Right.
right? I was kind of wondering, so what would be the loan to value? You know, somebody had bank statements, but they can't show full documentation. What's the typical loan to value?
Depends on your loan amount. You could be anywhere from 60 to 65% of the loan amount on those large jumbo loans doing bank statements.
Okay, so again, so let's say an agent, a whale, that means that agent is doing very well. They got a property, a listing in Pebble Beach or some other place, you know, and it's worth $30 million, right? And they listed for $30 million. So basically, they can get that thing funded only 30% down. Is that correct or not?
You would need a little bit more. You'd need 40% down when you're looking at something of that large amount. Now,
Okay,
we
40%.
also have, that's just on its own, though. We do have other options to help with higher LTVs, loan to value, higher loan amounts in relation to the purchase price through a couple different programs. We can cross collateralize other real estate that the borrower owns to help with leverage. And we can also allow them to pledge cash or stocks in our bank and pledge that against the down payment so that they're coming in with much less than you would if you didn't have those assets. So we do have some specialty programs that allows savvy borrowers with lots of assets to help and qualify for a higher loan amount than we would give anybody otherwise.
Okay, can you elaborate a little bit on that pledge asset thing you mentioned?
Pledged asset, and this
What
is
does
a
that mean
great,
exactly?
this is something that, again, most banks will allow to their private clients. Basically, if you have, let's say you had a $10 million purchase or a $2 million purchase, we're going to have a down payment requirement anywhere from 30 to 40%. If the borrower decides that
Yes.
some of that down payment they would like to leave in the bank and allow us to hold as extra collateral, well, it's still in their name, we just have a lien on it as extra collateral, then they can definitely borrow more than the required. So just as an easy example, a $2 million purchase would require 30% down, so that's 600,000. We can do, they decide they have stocks that they would like to pledge, equaling, let's say 20% of that. We can allow them to do a 10% down loan. So 90% of the value of the property we would lend to them. And the 20% difference between 70 and 90, they would put in our bank, the stocks or the cash, they can put it in our bank, still in their name. It's their money. It's just collateralized against their debt, just like their property is. And once they've had that in place for 3 years, then many times if the value has increased enough, we will let that pledge go. Or if they sell or if they refinance during that time, of course, then the money would go back to their sole control.
I think that's a great feature, right? So basically, somebody is buying a property again that's $5 million or something, instead of coming out all that money. Like yesterday, I was looking at some potential, a client, right? And I saw his portfolio, stock portfolio, $2 million.
Right.
Okay. And so he was trying to buy a property all cash. So he doesn't need to pay all cash for that and liquidate his stock. So all they have to do is like to move that stock to your bank, right? So,
Well,
and then they pledge it.
yes,
Is that what it
yes.
is?
So
Or-
the
Mhm.
stock that they pledge would equal part of the down payment. If they were going to pay all cash, you would want to see where all of their assets are. And of course, every situation's different, but you have the right idea.
Mhm. Interesting. Okay, cool. So if you're watching this and you have any questions, okay, don't just go make the move right away. Call me. The number's there on the screen. Okay, 844. Yeah, 844-806-6639. Okay, so you can call me and then I'll connect you to Cari. All right. So Cari, you don't deal directly with consumers, do you? No?
No, I am a wholesale account executive. So people, loan officers like you are my clients. You bring me the borrower's loan. We work closely together to find the best solution for their situation. And then we will, of course, fund the loan and again, have that borrower as part of our family. We would
Right. Again, you're watching the Money Market Show brought to you by the Money Market Inc., your Amazon for mortgage solutions. See that there? Okay, great. Okay, cool. So now let's get to the next item that we have on the agenda here. Okay, you're talking about the pay option cash flow maximizer.
Mhm.
What is that? Pay
That
option?
is
Is that a pick a
a
pay? Is that a pick a
yeah,
pay?
it is a
What is
pick
it?
a pay. It is a pick a pay. And basically what that means is we have an interest only loan. It is a 5-year fixed rate with a 30-year term. So the first 5 years it's fixed, and then the remaining 25 years it goes to a 6-month adjustable. Now, in those first 5 years, you have two options for your payments. The first option would be an interest only payment at your rate. So let's say your rate is 5%. The first 5 years, you can pay that interest only payment every month. And your other option, and this is where this is a very unique loan and very advantageous to people with fluctuating income, self-employed borrowers, commission-only borrowers. The other option is that you pay 2.5% below your note rate. So let's say your note rate is 5%. You could pay 5% interest only the first month. You could also pay 2.5% interest only the first month. It sounds a little strange. Why wouldn't I pay that every month? Well, you could, but what happens to the difference? Okay. If you pay the full interest only, you're paying 5%. If you pay 2.5%, what happens to the other 2.5% interest you owed for that month?
Go back to the back
Every,
of the loan. Uh-huh.
yes, and that is what the term negative amortization refers to. Every month that you do not pay the entire interest due, the remainder gets tacked on to your principal balance. And at the end of 5 years, we take the additional interest that you didn't pay, we add it to the principal, and we what's called recast or re-amortize the loan over the remaining 25 years, so that your payment will increase from where you were paying. But this is a tool that you can educate the borrowers that come to you for it, and what it's used for and how to use it wisely. This is not for someone who is buying more home than they can afford just so they can get in. It's not that kind of loan. In fact, you do have to put down at least 40% if you're doing a purchase under this. So you're going to have a lot of protective equity. And even if you do pay the lesser amount every month and raise your principal balance, you're still going to have equity at the end of 5 years. So
Exactly.
it's actually a very judiciously thought out loan. And after what happened years ago, 14, 15 years ago, banks are not able to do what got us into trouble back in those days. So we have to be very, very cautious about it and conservative
Yes.
in this. So it is for the right borrower, and it's a great option, especially in a rising rate environment. You can achieve a very low interest only payment that really doesn't exist out there right now. So it's if you do have a
Yes.
lot of equity and down payment, you're well qualified, I think this is a fantastic opportunity.
Awesome. So I was going to say that, yes, because back in 2006, 7, 8, you got this wealth savings, right? That had this pick of pay, and it got a lot of people into trouble. But back then, people were not putting any money down.
Right.
Right?
That's
They're not putting any
not happening here.
happening anymore. Got the Dodd-Frank and all that stuff. So yeah, if somebody hears this and go, "Oh my goodness, this is back again," no, it's not back again because it's totally different. You have a ton of equity. You got to put down
Right.
40%.
Right.
And so they just get flexibility that, hey, one day, I mean, maybe as a business owner, right? Sometimes you have the money coming in and sometimes you don't. Like, let's say a real estate broker, real estate agent, what happens is that, hey, some months are good, some months are not good. So this gives you the flexibility. You got your 40%, and then the market is not, it looks like the market is not tanking anytime soon, right? What do you think?
Oh gosh, if I knew that, I wouldn't have to get up and go to work every day.
Okay,
I wish I knew.
okay, cool. Now let's get to the, well, that's good. That's good. But I think by all indications, it's not tanking. That's my opinion.
Not
Okay,
right
because
now.
the demand is still very high.
Mhm.
Yeah, the demand is still very high, the supply is still very low. Interest rates, even though they're rising, they're not that high. They're still in the fives and stuff like that. So it's like we're good. We're good. Okay, cool. Let's talk about buy before you sell. What is that?
So we have a couple
Buy
different
before you
options.
sell.
Yeah, we have a couple different options that can help buyers not have to be homeless, not have to sell first and then go out and try and figure out where their next home is going to be. So we have a couple different bridge financing options. One is called cross collateralization, which is us giving the borrower a purchase loan and utilizing equity in their departing residence to help, again, lessen the down payment that we would normally need. And then if you have a client who maybe already has a good down payment, but they just can't qualify until they've sold their departing residence, they can't qualify with both. We have a very easy way to exclude debt on a departing residence from our income qualifying requirements. So there's a couple different ways of doing it. And then finally, we have what we call a bridge loan, and that is just a quick 12-month balloon on a property that they are going to be selling or is already listed. So if it's already on the market, it's okay. You can still get cash out. And that is just a loan on a departing residence, and it can be used for cash out to purchase a new property. We don't have to do the loan on the new purchase. They can take the money and invest it. They can take the money and buy a new property. It has no bearing on the loan we're giving them. So there's three options, and they can all play a part in helping a borrower buy before they sell.
Okay, awesome, awesome. So basically, you are saying so long as they have a listing agreement, right, for the departing property, that's all you need,
You need a
right?
listing. Yeah, you do have to have 6 months of
Um,
reserves on that departing property, because we want to make sure that if we're not going to debt service that debt, that they have the reserves needed to make that mortgage payment until their property sells. And we believe that most properties will sell within 6 months. So that's why we ask for that in addition to the listing agreement, but it doesn't have to be live yet. So that's the real big advantage here, because most loans, purchase loans, will only exclude a departing residence if it's under contract or even, sold. Some of them require it to be all the way sold, but at least under contract. We're only asking for a listing agreement, so it doesn't even have to officially be on the market when they buy.
So you require, how much equity do you require in the departing property?
We don't have a
At least
liquidity. I in 12 years, I've
how
only
much equity?
we don't require any a specific amount of equity in the departing residence. In the 12 years I've been doing this product, I've only ever had one loan where the departing listing agreement didn't appear to cover the debt that they owed. That's one out of hundreds. So it doesn't usually come up as an issue. As long as they're not underwater, we don't say they have to have a specific amount of equity, and we don't ask for an appraisal on that departing residence either. It's really important that be understood. We're just looking for that listing agreement. We'll probably do a search to see what the likely value is, make sure that that's in line and it covers the debt they owe, but that's it.
Okay, so long as they have 40% in
30.
the subject, 30% in the property they're buying.
30% down would be the minimum on
Okay.
a loan amount up to 2 million for a purchase. So yeah, they would have to have 30% down. And it's good that you bring that up because a lot of people, they don't have it. So they think, okay, well, how am I going to get this cash out of my departing residence before I have to buy? There's a couple different things you can do. You can have your borrowers, the absolute least expensive way of doing it is getting them set up with an equity line before they go into contract anywhere. If they have an equity line that allows them to access enough equity to come up with the 30% down, that is not a debt that we have to include in their underwriting because it's against their departing. It's part of the debt that we exclude.
Right.
So the best and cheapest way to achieve a bridge loan is to do that first. And then come to me only for the purchase loan because I'll only have a lien on the purchase and I'm only going to underwrite the debt on the purchase. If cross collateral works and they don't have time to set up that equity line, great, we do it that way. But plan A is that they already have the down payment and then they come to us for the purchase loan. That's by far the least expensive way to buy before sell.
Awesome. Okay, cool. Now let's get to the next one. Say flexible income niches. What does that mean? Okay,
Basically,
maybe all the stuff already covered, right?
I could talk for hours about income, and that's just because I've been in the lending industry over 20 years, and that's just what I like. But I can't imagine our audience wants me to talk for very long about debt ratios and income.
1 minute.
I will say this is that we do, again, like I said, we're a portfolio lender and we underwrite everything with a fresh set of eyes. We don't, look at charts and forms as far as filling out income line by line. So if you have a client who has complex income, maybe they've only been self-employed for a year, maybe they just changed jobs, maybe they have restricted stock unit income. A lot of people in the tech industry get paid through company stock, and that can be difficult to convert to qualifying income in the jumbo market. We totally allow that. So, and we have very flexible guidelines surrounding using that income. So that's something to keep in mind with your clientele. And then, of course, we talked about using bank statements instead of the tax returns. We have that. And there's just a lot of, and you and I can talk about that offline if you want to get into the weeds about it. But again, it just comes back to our underwriting flexibility and philosophy of make sense.
Yeah. So the last thing I want to cover today, and thank you again for coming on the show. And you are watching this, is the Money Market Show. By your host, I'm your host, Paul LeJoy, and it's brought to you by the Money Market Inc., your Amazon for mortgage solutions. So you're looking for whatever. So we covered a few things today, and this is for high-end individuals. Okay. So if you come in here and you're a first-time home buyer, and maybe with 3% down, that's not gonna work. Okay, that's not gonna work here. But we'll still have those programs, right? But this is today, we're concentrating, okay, your loan amount is at least $500,000, and we can go as high as $30 million. So you're watching this on, I think you're watching this on LinkedIn, okay? And you want to buy that big property, okay? So we can do that, okay? And you don't need to show your tax returns, okay? You can show your bank statements and asset depletion, right? You talk about that, all you have from stock, and so you can pledge that. But also, if you're an investor, right? So a landlord, you like cash flowing properties, this show is also for you. So, Cari, I want to talk about investor friendly niches. So we talk about DSCR. Let's talk about DSCR.
Okay,
Tell me about your.
The DSCR program, DSCR stands for Debt Service Coverage Ratio, and it's a very long-standing way of calculating property income on commercial loans, and it's kind of made its way into residential lending as well because it's a sound practice. It basically states that if it's an investment property and its net operating income covers their mortgage payment, then it's a good investment. because it's an appreciating investment, and the odds are that over time it's going to keep generating returns better than when it starts. So what we're asking for when we see something like that is that we have a just making sure that the market rents are going to cover and their net rents, once you take out about 25% for expenses. So 75% of the market rents, if that covers your principal and interest payment, that's a loan we can do. That does require a little bit more down payment as well. And we're usually doing things in the $1 million to $3 million range. So a lot of these loans, a lot of them are smaller, and we don't do small loans. So when we do our debt coverage loan, we're looking for loans of 500,000 and up. So it usually requires a larger down payment to achieve that debt coverage. So you're looking at about 40% down payment on something like that, but the rate is better than what you're going to see out there for the most part on the ones that allow higher leverage and lower loan amounts. So we definitely have a niche in that market, but the pricing is worth it. It's worth the extra down payment. So if you have somebody maybe doing a 1031 exchange that has a lot of down payment, this would be an excellent option.
Exactly. And also for people that want to refinance, this is good for them too, right? So
absolutely. Absolutely. There's lots of people out there that have this type of loan in the 6% interest rate range. If you have a loan of this nature on an investment property and you're in the 6s and you have at least 40% equity, it's probably a good idea to talk to Paul and see if we can get you a lower rate.
Exactly. And then another thing is that if they, let's say their credit score is very good, 740 and above, they do get some credit, right?
A little bit, yeah. And again, that banking relationship can help with the rates too on that program.
So if you're an A-paper guy, okay, A-paper landlord, or you're a real estate agent watching this, and you work with investors, right? So long as the debt on the property is $500,000 or more or higher, and basically if the credit is very good, credit is 700 plus, okay, they can go lower than that, but if 700 plus, they get a break on the rate. And if they also have a banking relationship with AXOS Bank, they also get a break on that. So I've seen the rates, and I see the rates every morning. Compared to all the lenders out there that we use for DSCR, I mean, AXOS Bank's rates are way better. Okay. So let me ask you this question. Is there a limit to the number of properties that they can finance?
No, and that is definitely something that we are, I think, very unique in that we don't limit the number of properties a single borrower can own.
So if they had 20 properties, it doesn't matter, and they want to acquire 20 more.
Yeah. So I don't think I've ever done 20 loans for a single borrower, but I've done probably a dozen. So, we're going to have a limited exposure at some point, but whatever they have already at the time they apply with us, that is not going to be an issue if it's several. And in fact, on the DSCR program, we don't even really, we're not considering the cash flow on those other properties. We're only considering the subject properties cash flow when we're underwriting that loan.
In which situation do you require like more than one appraisal?
That's based on the loan amount, and that is when a loan amount is over $1.5 million, then we would need two, otherwise one.
So okay, 2 is a top, right? So if let's say the loan amount is 2 million, how many appraisals do you need?
2. Yeah, it's just 2. We don't want another one. That's too many.
They cannot be done by the same appraisal, right? So you gotta have 2 separate appraisers.
Exactly. Yes.
Wow, that's cool. So, Cari, as I said, basically the audience here, my target audience is real estate agents. Okay, people really want to take that game to the next level. Okay, so the tilapias, the tunas, and the whales, and then of course the unicorns, right? Today, I met a unicorn. Man, basically, she's been doing it for only 4 years, and last year she grows $4 million. And I think this year she might, I don't know, maybe she's going to $8 million. That's really good. Okay, so what would be your advice to someone like that, or anybody who wants, okay, again, to my audience, okay, let's say somebody's watching here as a real estate agent, what would you advise them to do? I mean, you have a whole slew of products.
Just make sure that you are aware of all the different options out there, all the unique options that lenders have to offer, because it starts with the money, right? without the loan, a lot of people, I mean, God bless the people who can put down all cash. And for those all cash buyers, we can do an immediate delayed purchase if they want to recoup their assets after buying all cash. So you need to make sure that you refer your clients to the right advisors with regard to both wealth and debt. So you just need to know all the different options out there, especially in a market like this, when you have clients who own and need to buy first their next property. That's, I think, the most important thing takeaway right now.
So, Cari, it was a pleasure having you on the show today. We got to go places. I'm gonna close at least 4 loans with you, okay? With all this stuff, some really cool stuff that you talked about today, right?
Right.
Any parting words that you want to share with us?
Just bring us more loans. We love it. I've been doing this job now for probably almost 12 years. Our division's been around for 13. The bank's been around for 22 years. So we are a solid bank, AXOS Bank. And we would love your business.
Yeah. And then you are always there when we call, right?
Yeah.
And I saw the other day you responded to, or you sent an email like midnight or something like that. That's good.
Oh, yeah. Yeah, I have to right now. It's been work 24/7.
I love the support. Thank you so much, Cari.
You're welcome.
All right. All right. Bye-bye.